Welcome back. My name is Arya. I don't waste your time. Let's get straight into it. News broke out that Warren Buffett, who is the greatest investor of our time, has actually trimmed his Apple position by roughly 13% in the most recent quarter. In today's video, we're going to go over why that exactly is and what could that possibly mean for the future of both Apple and Berkshire Hathaway. Additionally, we're going to go over the most recent Apple earnings as you guys overwhelmingly voted for that. And then we'll look to Twitter for some additional commentary. And at last, go through my valuation spreadsheet, which I include in every single one of my videos to see whether or not Apple is undervalued, fairly valued, overvalued, so on and so forth. And one last thing that I decided to throw in here as well, a very damning piece of evidence on what stage Apple is currently in regards to their growth trajectory. With that being said, let's start all the way at the beginning with Warren Buffett and his trimming of Apple. So the annual meeting for Berkshire Hathaway is currently ongoing as I'm recording this video, but in that meeting, Berkshire Hathaway reported that its Apple bet was worth $135 billion, implying around 790 million shares that would mark a decline of around 13% in the stake. This is, of course, a CNBC news report. This is the second quarter in a row that Omaha-based conglomerate has trimmed the stake in the iPhone maker. It sold about 10 million Apple shares, just 1% of its massive stake. In the fourth quarter, this filing, when accounting for the change in Apple stock price, would imply Berkshire sold about 116 million shares. So, what does this mean for ongoing Apple shareholders as well as Berkshire Hathaway shareholders? I think it's very important to understand that when Buffett was buying Apple, it was roughly in the 2016 to maybe even the early 2018 timeframe. And since then, they haven't really added to the position. And in fact, they've actually trimmed the position multiple times, and it's trailed off to roughly 900 million shares, which in the coming quarter, it's going to be just shy of 800, right? So they've trimmed it a little bit. What you have to understand is that when Buffett was buying these shares, it was at a significantly lower cost basis. Over here, ValueCider, which is the website we're using here, they provide us two different methods in which they estimate what the cost basis for Buffett's stake is, right? So roughly in the $30 to $40 range. What that means is that the stake that Buffett has in Apple is up roughly 400 to maybe even 500% in gains. So when he was buying it, and the last big ad that he had was Q1 of 2018, it was a roughly 21% stake for him. And since then, the Apple stake has grown to roughly 50% of the equity portfolio. Now, of course, if you guys didn't know, the Berkshire Hathaway conglomerate is more than just the equity portfolio. They have a bunch of wholly owned businesses that don't show up here. But of the public companies, which is the equity portfolio, they have a roughly 50% stake in Apple. So I think it's really important to understand that Buffett is sitting on massive, massive gains with Apple. And it does represent half of the portfolio. Now, what you have to understand is that there's two different reasons why he would trim. If he's trimming to go cash, I think that's very worrisome. It shows that Buffett is trimming for simply the sake of getting away from Apple and reducing the concentration risk into Apple just to go cash and preserve the gains that he has. But if he's selling to possibly go into the secret holding, which we still don't know, by the way, it's been going on for roughly 4 or 5 months, where if you didn't know, Berkshire, they asked for special permission from the SEC to not reveal the stock that they've been buying into. So if he's trimming Apple to possibly go into the secret company over here, I think that's understandable. Apple has ran up a lot, and over the past roughly 6 to 8 years, it's ran up a lot in stock price, and it hasn't been growing that much the past couple of years. He's trying to he obviously still believes in the company because he hasn't sold the entire thing, but he has sold to diversify away into other big bets that he likes as it stands currently, right? There's opportunity cost to every single holding, weighing his options on whether or not it's worth it to continue holding Apple, especially with the amount of growth that he estimates is left in the tank for Apple. Moving on, we look to Twitter to Brad Freeman, which is a great follow on Twitter. He does earnings recaps and all that type of stuff. But as you can see, in the most recent earnings that Apple has provided for us, their revenues declined by roughly 4%. So this kind of speaks to what I was just mentioning with the amount of growth left in the tank for Apple. If their revenues are declining and the revenue hasn't moved in like 3 years or something like that, is it time to call it quits on Apple? Has Apple matured to the point where they can't continue growing revenues and the amount of growth that they got left in the tank is diminishing with every single passing year? I don't know. I'm not someone to try to decide that or pick that. Apple has had multiple years where the revenues didn't move right before the revenues exploded up, where they continued innovating and they had the new services come out and they had the AirPods come out, they had the new iPads, the new Macs, this, that, whatever, right? So Apple's a cyclical company at its core, right? It's a device maker and people can easily extend the duration of their devices, right? especially with the most recent phone, right? You could see that people are even buying older versions of the phones or buying secondhand, right? This has been a glaring problem for Apple over the past however many years. So it is a cyclical company at its core. And what you have to understand is revenue growth on a couple year basis isn't really indicative of where that revenue growth is going to go in the future. Thankfully, Brad Freeman here for us has provided the 3-year compound annual growth rate, and you could see that it's basically flat. Over the past 3 years, Apple's revenues have not moved. If you're investing into Apple today or continuing to hold it, you're betting on the fact that this is going to reaccelerate, and it's going to reaccelerate because of some new growth drivers for the company, whether that would be Apple Vision Pro or some other thing. Additionally, I want to go over this tweet by the long investor. He mentions here that Buffett is a fundamentally driven investor. He's consistently ahead of the market. He caught the decline from December and reduced his Apple exposure for the second quarter in a row. Buffett is not listening to biased views on X. He does his own work, takes action, and strictly keeps to his strategy. And I somewhat agree with this, right? Of course, Buffett, I'm sure he doesn't even have Twitter, but Buffett is looking at it, and he's looking at the risk versus reward of continuing to hold Apple compared to putting the money somewhere else, whether that be cash or the secure holding that we just mentioned. Moving on to valuation. As you guys know, in every single one of my videos, I include this growth free cash flow calculator that I've built myself. It is very similar to the PEG ratio. So it takes the current free cash flow valuation of a company and divides that by how fast we expect those free cash flows to grow in column F over here. And as you can see, Apple is about middle of the pack, maybe even a little bit under, right? I estimate that Apple is overvalued as it stands currently. So you're paying roughly 29 times cash flow to get roughly 11% in free cash flow growth over the coming years. And again, these are rough estimations, right? If Apple were to blow it out the park and grow at 15%, you could see that all of a sudden the valuation is extremely undervalued. So this does really depend on the assumptions that you're willing to put into the free cash flow calculator. But as it stands currently, with the estimations that I've put in place in the calculator, I don't think Apple is that attractive of a company. Even compared to other big tech peers, Google, Amazon, and Meta platforms trading at significantly better free cash flow to growth multiple. Meta, which isn't of course a one-to-one example, is trading at roughly 29 times free cash flow, is also growing those cash flows at roughly 14%. So for the same valuation, you're getting significantly faster growth. And of course, I understand there's a qualitative aspect to this, whereby you might argue that Apple has a significantly stronger moat, and of course their revenues are drastically different. But at the end of the day, the dollar earned holding Meta is no different than the dollar earned holding Apple. Moving on, I want to go over this key metric that I've been able to identify from actually a fellow YouTuber, Brian Feroldi. He was able to point out the what's called shareholder yield. So, of course, you guys are probably very familiar with the dividend yield of a company, where it's the amount of dividend that the company pays out on an annual basis divided by each share price. There's also the buyback yield of a company, right? So the amount of shares that company is buying back. So for Apple's case, it might be like 4% or something like that. And then additionally, the amount of debt that company is paying down. The shareholder yield is simply all of those things combined together. It's the debt that they're paying back, the amount that they're buying back, and the dividends, right? It takes into consideration all the different ways whereby a company is able to return capital back to its shareholders. And as you can see, I've put up the shareholder yield of the company and the free cash flow yield of the company, and I've compared the two. And of course, as we know, based on the statement of cash flows, all these different things come from the operating cash flow of the company, which free cash flow is simply operating cash flow minus the capital expenditures, right? So as you could see, over time, we should see that the free cash flow yield is roughly in line with the shareholder yield, right? Because how else would they be paying all this free cash flow back to the shareholders if they don't have that much to begin with? And free cash flow yield here is in blue, and you could see that roughly in the 2019 timeframe, Buffett had his biggest holding in the company. The total shareholder yield was roughly 14% at its peak, which is significantly higher than the free cash flow yield. So this probably means that they were actually borrowing a lot of debt to be able to do the buybacks and the dividends and all that type of stuff. And again, you could see that the shareholder yield spiked up in March of 2020. This is due to the COVID crash, of course. And you could see that over time, the free cash flow yield of the company started to roughly be in line with the shareholder yield, right? And as it stands currently, the current shareholder yield is roughly 4%. So every single year that you are holding Apple shares, the company is returning roughly 4% of value to you. And the current free cash flow of the company is roughly 3.6%, right? So it seems that they need to borrow a little bit of debt, or they're using their excess cash from previous periods to be able to purchase a little bit of additional shares or return capital back to you in the form of dividends. And again, you can see that this kind of speaks to the stage in which Apple is at. if they're returning roughly 100% of free cash flow back to you, the shareholder, this kind of means that they've ran out of growth opportunity. Of course, I'm not going to sit here and argue that Apple has ran out of growth, but it does speak to the fact that management believes that their capital is better put to use if they are going to make buybacks and issue a dividend. With that being said, a company like Amazon, which is of course my biggest holding, if you were to do the same exercise with them, you would see that the shareholder yield of the company is roughly about half where the free cash flow yield of the company is. Again, I'm not going to sit here and argue that Amazon has more growth left than Apple. That is, of course, what I believe. But this does speak to the fact that management believes that the capital that Amazon has is better spent in the business, making more warehouses, buying more trucks, and doing all the various capital expenditures that the Amazon business does, compared to Apple's management, where they think their capital is better spent returning it to the shareholder via the dividend, via debt pay down, and via the massive buybacks. With all that taken into consideration, what am I going to be doing with my personal portfolio? As you guys see on screen, my portfolio is heavily concentrated into a handful of holdings, and me personally, as I mentioned at the very start of the video, I don't find Apple to be an attractive investment as it stands currently. Even if Apple were to trade down in price significantly, I still don't think Apple would be an attractive investment. There just simply isn't enough growth for that company, and I don't see a path whereby Apple could re-accelerate that growth on a going forward basis. And last, I'd like to ask you to do something that costs you nothing but helps me out greatly. If you could please hit the subscribe button, I'm going to continue to post extremely high quality videos just like this one. You guys could always go back on that decision if you end up not liking the videos, but I highly doubt that. And also, one last thing, if you go over to my Twitter, I'm going to have my portfolio pinned at the top of my page at all times. With that being said, thank you very much for watching. Have a great day.